what is the purpose of the market? Okay, so very often, we think the market's about buying and selling and speculating, and we see things that way. But in essence, the purpose of any market is to facilitate trade. Okay, so in a very basic sense, how auction market theory works is that price will trade up to a point where someone provides liquidity. Okay, and we call that liquidity a seller. And at that point, it's all about how much liquidity he provides. If he provides a lot of liquidity, the reality is that the market is then going to move away from him because it's found that liquidity, and we then will see the market move in the opposite direction. And the market will then move towards where it finds the next bit of liquidity. Now, sure, it could come to this line and we can call it support. It could make a higher low and we call that a higher low. And that in essence is where the buyers step in and they provide liquidity. And that's the purpose of the market. Its job is to facilitate trade. And how does it facilitate trade? It has to go in search of, where's that person that wants to trade? Oh, I found him. Where's that person that wants? Oh, I found him. Where's the person who wants to trade? Oh, I found him. Okay, and that's the purpose of the market. It's to keep facilitating trade between points of liquidity. Now, if you've ever read Anna Cooling's book, Volume Price Analysis, it's probably one of the best books you can read as a trader because it will very importantly outline the purpose of volume. Okay, and volume in a very, very basic sense, how you want to understand volume is it showcases participation. Okay, that's all volume is. It's true. It can never be false. If there's high volume, it means there's a high degree of participation. If there's low volume, it means there's a low degree of participation. Okay, so how you can think of that, if there's high volume, there's a large degree of liquidity. Now, in some instances, that liquidity is provided over a narrow amount of prices, and in some instances, it's provided over a wide amount of prices. Two examples, okay? You can have a market that in essence does this. It goes up, down, up, down, up, down, and it can be a high volume day, okay? Now, in that high volume day, you have sellers here, you have buyers here. And we call this a market that's absorbing. The market's absorbing of the buyers, it's absorbing of the sellers. High volume, high participation. Now, at some point, this fight has to be lost by someone and won by someone, which means at some point, whichever way it breaks, it's probably going to continue. And if it has a fake break, it's probably going to reverse and take out the other side. Okay, that is one pattern play that's extremely profitable, right? But it's got to be done with high volume. Another way is we could have a trend day where the market just trends the entire day and it goes up and up and up and up on high volume. And why do we have that high volume? Well, because we have lots of buyers buying the market. Everyone's in agreement they want to take prices up. Anyone trying to short it is being forced and stopped out of the market. Okay, so two different types of structure, both high volume regimes. And in both instances, the market is just facilitating trade between where liquidity is. In the first instance, liquidity is being provided on both sides by the sellers and by the buyers. In the second instance, there's no liquidity being provided by the sellers. And so the market has to keep going in search of that available liquidity. And when it does find it, it takes it very aggressively and then goes on in search of the next bit of liquidity. Okay. Now, in low volume regimes, you can have these exact same patterns. Okay, it doesn't mean that low volume means that the market cannot trend. Of course it can. It's just a different regime. Okay, now typically as a very, very baseline rule of thumb, when there's a low volume trending move, okay, ultimately that market will keep going until it finds that volume. Okay, equally in a low volume consolidation zone, that market could extend, it could continue, it could reverse, it could do all sorts of things. Okay, so low volume and high volume doesn't mean trend, it doesn't mean anything. It just means they're two different types of regimes where there is participation. Okay, however, as a baseline rule of thumb, and this is what I want you to take away from high volume versus low volume, and you'll learn this if you go read Anna Cooling's book. A high volume market regime you want to pay very close attention to and mark out those points in the market. Why? Because if Goldman Sachs stepped in and started buying the S&P at 4,000, it means that the likelihood of us coming back to that point is very, very low. In other words, the market's probably not going to come back to that point in the near future. Why? Because it's a big institutional player buying the market up. Okay, the same with these big zones. When you have these big absorption zones, at some point it resolves itself, and it's unlikely that the market's going to come back to that zone once it breaks out. Okay, and those high volume points form very important turning points in the market, very important reference points in the market. Typically, you'll see them very, very rarely get tested for weeks and months. Okay, and that's why we pay attention to high volume regimes versus low volume regimes.